What's up, everyone, and welcome to the daily macro update for Tuesday, February 10th. Taking a look at some of the macro data here this morning, we received the retail sales report for January, and it came in a little bit under what most were expecting, giving a little bit of a hit to the Goldilocks narrative that we've been seeing in the markets play out over the past several weeks here. And so, when you take a look at the monthly data, it shows that it's flat. But for those that have been paying attention to this channel, as well as look at the year-over-year rate of change, that's what we like to pay attention to, because that gives you a much more, deeper view of what the actual trend is doing. And so when you take a look at the year-over-year metric for retail sales, you can see here that this was pretty low, right? 2.4%. If we just go back 3 years here, we can see that for the month of January, I mean, that is pretty low. Or I'm sorry, for December, that is pretty low, considering the December print was around 4.6. So definitely some interesting things going on right there with retail sales, definitely in a deceleration, right? That's pretty clear at this point, which again, retail sales is a large leading indicator. And if that's actually slowing down, then that's contrary to some of the other data points that we're getting with growth reaccelerating. So it's just one data point, but it is something to pay attention to. And the market reacted appropriately with a large decline in 10-year bond yields, as well as long bond yields, right? And then also as well, we finally saw a breakout in utilities, which we were talking about this on last night's Monday macro wrap up. And yeah, so definitely interesting seeing utilities finally have a breakout there to bullish trend. This recently went neutral in our model. And so after today, after the close here in about 7 minutes, this will definitely go to more of a bullish trend. So that is definitely interesting to see that there. Definitely in line with what we're seeing with the macro data. So it is almost like, the macro data is being reflective in the price markets pretty well. And because of this, you're seeing a pretty decent down day in things that have been going up a lot recently, one being Walmart, as well as Google. Google's starting to lose some trend here as it's closing below this level. It would need to bounce here in order to regain strength. So if Google actually starts to break down, then that'll become less actionable. Taking a look at the S&P 500 today, it still remains in bullish trend. I know I'm not in my office today. I'm actually at our new house here, which we're moving in on Friday. So got a busy weekend ahead of us here in this household. So hopefully we'll have my new office set up and everything ready to go. Got super fast internet, so don't need to worry about any type of lagging or anything like that. But yeah, you guys will be looking at a new studio here soon. But taking a look at the ranges here today, top end of the trading range for the SPY 703, low end of the trading range 673. So pretty large range there, and that's due to the fact that volatility has been accelerating, over the past couple weeks. And, speaking of volatility, the volatility index of the S&P 500, it does remain in bearish trend, but, it's still having a broadening or more of a longer term acceleration here, right? I mean, whenever you start to see a strengthening in the VIX, you get more and more higher and higher probabilities of those VIX spikes, which we've been seeing over the past couple of weeks. So got to be a little bit cautious here. This is more of a, whenever you get some up days and down days in the VIX, I'm taking opportunities to, take profits, raise some cash, and get ready for the next larger opportunity here, which it looks like could be more of these stronger risk-off types of signals with utilities and others just like it. But yeah, really interesting to see this huge kind of growth fear day after, a few weeks of growth confidence, right? I mean, dollar down, long end of the yield curve down. And what we've been talking about too, if you go ahead and watch last night's Monday macro wrap up, when paying attention to the yield curve, it's been continuously steepening here. But if we end up getting to a point where this actually loses its bull trend and goes into a flattening phase, then that'll be more of a signal of stagflation, you'll start to have more sentiment fears of recession. Not saying that would happen, but you get more of that growth scare type of environment where utilities continues to perform and things like that. So definitely want to pay attention to the yield curve here. If we do end up going into some type of bull flattening phase, this would mean that we would be going more towards a liquidity trap. And, it is interesting with this signal being what it is, because we do see liquidity sensitive assets like Bitcoin continue to weaken and continue to fall, right? So, what's happening right now in the yield curve is continuously that bull steepening twist, or that steepening twist, where yields actually go in opposite directions, right? So the long end of the curve has been rising while the short end of the curve has been dropping, which isn't necessarily a classic signal of growth recovery. It just means there's something that's out of whack there. And at some point, the tug of war between the two yields, one will win out, because it has to happen that way. These twists in the yield curve aren't sustainable, and they're pretty rare when it comes to market history here. And so if we do get a winner here, which as of today, it looks like the 2-year yield coming down is actually going to be the winner, right? So that the 10 years coming down, the long end of the curve is coming down with the 2-year. That is more of a growth slowing signal, right? Which would get down inflation, but also too, that's when you typically have large spikes in volatility, and you have to be quite cautious, So not saying that's what we're doing immediately right now. I still want to see more signals within the market confirm this. You can't just look at one day's worth of data and declare that that's the case, but that's what today signaled, right? We did get some comments from some Fed leaders here. So the Cleveland Fed's Hammock, said that the policy rate right now, so interest rates, are in the vicinity of neutral, meaning that, once they get to neutral, they're no longer going to cut rates meaningfully, right? And so even if they do end up, cutting rates from here, they're not going to be by much, right? So we're not going to get that 1%, Fed funds rate that, the administration is asking for. But on the other hand, though, we also have some people from the Fed saying that, if the labor market continues to cool further, we will be having to think about cutting rates quicker than maybe what is being priced in right now. If the labor market and inflation continues to cool, maybe they'll have to do it by next meeting. So that's why with this week being both non-farm payrolls tomorrow and then inflation on Friday, this is a big week. We're going to get a lot of confirmations by the end of the week on whether or not we're going to get a rate cut sooner than what's currently being priced in, which is in June. So big week this week. Let's see. Yeah, taking a look at this new macro indicator dashboard that we just produced on our website here. If you go to our website, macro-optics.com, and go to the indicator dashboard here, you'll see some pretty cool things that we just put up. If we take a look at the global government debt to GDP, unemployment rate, interest rates, inflation rate, as of right now, the United States is at a 2.95% headline. But, if you take a look at the inflation data that we're seeing here, Hold on 1 second. Let me move my face here. All right, let me know if you guys can still see this here. Yeah, so for the most part, inflation has been coming down, right? So I've broken this up. My team and I have broken this up into the major components, right? So you have PCE prices in black, which is at 2.7%. You have shelter coming down. You have food and beverage inflation kind of having a little bit of an acceleration, but still remaining well within the approaching normal range, although it has strengthened from the bottom that it did in 2024. And then services inflation also continues to come down. So, I mean, that's what the Fed says when they go on TV and they say, hey, inflation is coming down here. What's interesting as well is when you take a look at the inflation indices from the Fed here, you can see that we are continuing to get more of goods prices accelerating, but when it comes to services pricing in red there, that's the services prices for the Texas Fed. Those continue to remain pretty low, and that's really what the Fed cares about right now, because they've already blamed all the goods inflation and manufacturing inflation on tariffs. And so this is why they have so much confidence with what they're doing right now. It's because of the services inflation is continuously coming down. So that is what we're seeing here today. But right now, the Cleveland Fed is pricing in that the headline inflation rate is going to come in around 2.4%, which is actually below consensus. So we'll be interested to see how that works out. If we do get a pretty bad jobs report tomorrow morning, and then we also get inflation cooling more than expected, you're going to see more inflation talks, or interest rate cut talks. But it would be in the context of a slowing economy, which may not be the best thing for the broader equity markets, especially some of the things that have been doing well, like small cap stocks. We could see more of a strengthening in things like utilities and consumer staples, things like that. So that is a little bit of what I am seeing here today. Appreciate everyone's patience. I know that we started a little bit late today, but yeah, the market just closed here. And so, yeah, when taking a look at kind of the broader market, you had a little bit more of a correction in some of the major players, but that's pretty much all I have for you guys here today. There are some dips to be bought for sure, but yeah, some of the things that we've been calling out are definitely starting to strengthen here. So good job on those. All right. Hopefully everyone is having a fantastic day wherever you are. Let me just spend a little more time here on this dashboard. Let me just show you guys a couple of cool things here. Let me know if you can see this. 1 second. Let me see if I can actually, for those who are on TikTok, you're gonna have to join our stream on YouTube here. Let me know, can you guys still hear me? Put a 1 in the chat if you guys can still hear my voice, even though I'm just sharing the screen here. Sweet. All right, so yeah, just kind of going through some of these here. What's interesting is that when taking a look at net central bank liquidity, so I know that there's a lot of words going on here, but just take a look at this blue line here. This is essentially the net central bank liquidity metric that my team and I like to track. And, as you can see, this is compared to the price of Bitcoin in orange here. And whenever you had this cross here from positive to negative, that's when you start to get a lot of these risk assets going down, right? So what's interesting is that, you had a cross like this back in January of 2022. And then from January of 2022, it then bottomed around, September of 2022, which is right around when the market also bottomed, right? So it's highly important to be paying attention to what the change in net central bank liquidity is. And as you guys can see right now, um, it's deeply negative, right? And it continues to decelerate. So no wonder why things like mega caps as well as liquidity sensitive assets like Bitcoin have been not performing so well. Some of the major leading indicators that we like to pay attention to as well. These are things like retail sales, heavyweight trucks, these core capital goods orders, as well as private construction spending in the residential area. And although you can see a little bit of an acceleration in capital goods orders, you still have both negative construction spending as well as negative heavyweight truck sales, right? Even though it has had a little bit of a rebound there. So it's mainly showing that the real economy could be recovering here, but it's still not in any way, shape, or form a huge strengthen right now, right? The majority of the GDP that we see is mainly coming from government spending, right? So interesting seeing that there. All right. Although I do think government spending is starting to come down a little bit, and that's partially why we are starting to see also a deceleration in liquidity conditions, because you can't just hold it up forever. And later on in 2026, around fall, that could be start to where a lot of this danger starts to manifest itself. But still a little bit of a ways until then. For now, we can just keep on rolling through with the bull trends that are making us money. All right, Matthew Wright says, if we get a bad jobs report and a bad CPI report on Friday, what's the game plan? Well, I mean, it's more of the same of what we've already been seeing in the markets, right? I mean, remember, this process is never like we look at headline data and then we make a move, right? The headline data that comes out, so the jobs report that comes out tomorrow, the inflation report that comes out Friday, those are all lagging metrics that are confirming our current thesis, right? So they're either going to confirm or not confirm what's been making us money in our portfolios, right? So it's not what's the game plan after the fact. It's we have a game plan right now. Are those reports going to be supportive or dismissive of our current game plan, right? So yeah, it's kind of like you're already driving the car on the highway, and if you have things that are coming up in the road, you just swerve out of the way, slow down, whatever, right? It's not like, should I leave my house at all because there's a tree branch on the highway? So if that analogy makes sense. But yeah, we'll see what happens though. Yeah, so the expected inflation print on Friday is 2.5%. From 2.7. So if we get 2.4, that would be less than expected and more conducive to rate cuts. So what's interesting is that, this is all coming down to kind of the no landing stop go cycle that we've talked about on this channel for quite some time. But this is what we've been doing since 2023, but now as liquidity conditions are coming lower, we have a higher chance of volatility accelerating, in this ending. But yeah, right now we are currently in this stop phase, right, where you get more of a hawkish Fed, rate pause, you get stocks to drop. Now we're starting to get some hard landing fears. What are the next steps that typically have happened? Then you get lower inflation expectations, and that is where you want to buy some. So I guess this goes towards Matthew's comment on, historically what's been working in this cycle with what the game plan is. And that's when you get lower inflation expectations from here, a little bit of a recession fears, what are the things that are holding up strength? Because those are going to be the dips to buy, right? So, Ralph, are you saying that it's a little bit difficult to hear my microphone? I am in my new house that doesn't have any furniture, so you might hear an echo. But let's see here. Do I have anything that's green that I can put behind me? Oh, look, a paint rag. I don't have a bookshelf, but I have this paint rag here that's green. So there you go. There's the green bookshelf there. The S&P 500 is still bullish. If the reports indicate growth decelerating, would we be looking for a move in the dollar, bear flattening? I mean, what's already starting to happen is yields are coming down. So we're already starting to get early indicators of growth not being as strong as originally thought. Now you can still have an acceleration, but and it's still well within its steepening trend. So we really just need to see what happens with the reports and then what the reaction is in the market. Is silver showing strength? We prefer gold over silver right now. So when you take a look, I get the model out of here. If you take a look at the silver gold ratio, you can see that gold has been winning versus silver. Another way I can put this is just flipping this upside down so you guys can kind of visualize this a little bit better here. So here's gold versus silver, right? So gold has been having a pretty large jump compared to silver. And yeah, so gold is looking a lot better right now. If I was to choose between one or the other, it would be choosing gold to buy dips on, which is kind of what we got a little bit today. But hopefully that answers your question. So, yeah, that's what we were looking at here. We can go through some of the other indicators that are in here. In terms of growth, these are the metrics within GDP that we want to be paying attention to the most. And what's interesting is that 3 consecutive quarters of huge equipment investment. That's pretty much government subsidies going into the infrastructure for AI, while at the same time, you're getting durable goods consumption continuing to fall with that green line. And then services also kind of waning a little bit, but not too bad. And then what's interesting is that the rate of change of government expenditures is also coming down. When it comes to the labor market, total non-farm payrolls, has pretty much stopped going down, although it is pretty low. And then job openings remain negative, and average hourly earnings have pretty much stopped going down as well. So that's why they're saying that there's a bottom in this housing crisis, or in this labor market crisis. I don't think so. I think it's going to get much worse, but we'll see what happens. But yeah, we can go ahead and end it there. Do you care about the fundamentals on a company? Yeah, of course, of course. Is it high up in the priority list? Not really. The trend, as well as what's going on with the macro, are much bigger things to worry about. All right. All right, we're going to go ahead and end it there, everyone. I appreciate everyone for joining. I should be back in the office tomorrow with normal audio and things like that. But yeah, I appreciate everyone for joining, and we will catch you in tomorrow's daily macro update. Bye, everyone.